Hello friends, good evening to all of you. And now TRS is what? TRS is a total return swap. TRS is a total return swap. Now in case of the TRS, the protection buyer swaps with the protection seller the total return on the asset in return of the premium. The total return is actually swapped. Protection buyer is going to swap the total return with the protection seller on the asset in return of the premium, right? The premium is arrived by adding a spread to the reference rate like LIBOR. So what does it mean? So TRS is what? TRS is also derivative contract. So one party transfers the total economic return of the reference asset. So just consider we are having the underlying asset. We are having the underlying asset, and the total economic return that you are going to get over this particular asset, that is going to be transferred to the other entity, right? And further the total return, the protection seller, or we can say the protection seller is going to give a fixed rate, let's say based upon LIBOR, that is London Interbank Offer Rate, which is not now in use that much. Let's consider it to be MIBOR or SOFR. Let's consider it to be MIBOR, and some spread is fixed over it, and that some spread is fixed over it, that's it, right? So that particular return will be paid by the protection seller to the protection buyer, and total return is basically transferred to the protection seller. Now in this way synthetically, what is being done? Synthetically, the protection seller is able to create a total exposure on the reference asset. Now the protection seller is here. The protection seller B has not lent money to the loanee over here. So this is a loan, right? So protection seller has not lent the money to the loan over here. But what happened? The overall return which was there in the case of the loan is now available with the protection seller, and a fixed amount based upon, let's say, MIBOR plus spread, that is to be given by the protection seller to the protection buyer. That is a total return swap, right? And it's basically what it is representing, the off balance sheet replication of the financial asset. Now in the case of the bond, like, you get a total return you get. Now that total return is being paid by the protection seller to the protection buyer, and in return a total synthetic exposure is created over the asset, right? That's the scenario related to the total return swap. I hope that you must have understood the concept related to it. Okay. Now, what's the major part? That in case of the CDS, when we learnt about CDS was a off-balance sheet exposure, totally fine with it, right? In case of the CDS was capturing only and only the credit risk. But total return swap is going to capture the credit risk as well as the market risk, because if the benchmark rate increases or decreases, that is also covered under the TRS, but that was not covered under the credit default swap. But in case of TRS, that is covered. Okay, so that's about the TRS. Then after that, it's the credit spread option, CSO, credit spread option. So kindly please confirm if you have understood the concept so far, so that we can move further and could be learning the concept related to the CSO. And if you want to get the PDF of this file, just do WhatsApp CAIIB to the number 83609 Do WhatsApp to this number, and also you can be downloading the application. And if you're iOS user, use the ORG code, which is GEGKT. GEGKT is the ORG code, and start preparing for it. So it's about the credit spread option. Now credit spread option, definitely it's a derivative instrument, because we are learning about the credit derivatives only so far, right? And in case of the credit spread option, it provides a protection against the widening or narrowing of the credit spread. So if the credit spread is going to be widened up or it's going to be narrowed down, right? So it is going to provide the protection against the same. That is a credit spread, right? So if there is unfavorable migration or credit spread risk is there on an asset. Let's say if it is downgraded, previously it was rated triple A, but now it is rated double B. Now, definitely, if there is unfavorable migration of the credit rating, right? So it's going to provide protection against the same. So the credit spread option is going to transfer the credit spread risk from protection buyer to the protection, basically risk from the credit spread. It's going to transfer the risk, credit spread risk from the protection buyer to the protection seller. And there will be a periodic payment of the premium. Like same the case of the CDS. Here is a protection buyer. Here is a protection seller. And here is a originated loan, which was previously rated AAA. So it says if there is downgrade of the credit rating, right, in that scenario, the compensation will be made by the protection seller to the protection buyer. And in lieu of the same, protection buyer is to pay a fixed premium to the protection seller. Clear with it? So that's about it. And after that, it's about the securitization. Now, I just told you somewhat about the securitization. Now, securitization is a point where we're going to pool the assets. We are going to pool the assets. Now, if I want to basically explain the points to you again, let me just draw the diagram again here. So here we were having the bank or the origination bank, which is having the pool of the accounts. Now that pool of the account is sold to a ARC, that is a asset reconstruction company. Asset reconstruction company is going to create a SPV for the same purpose. For every single scheme, the SPV, that is a special purpose vehicle, is created and the assets are transferred to the SPV. And also under this pool of the loan accounts, ARC is going to make efforts toward the recovery and the settlement of the securities, right? And SPV will be issuing the security receipts. Now these security receipts are to be rated by the credit rating agency, and those will be available for the investors. And majorly the QIBs, that is qualified institutional buyers, are going to make investment in these SRs. That's the security receipts. Now this way what happens, even if the bad loans are there, even if the bad loans are there or non-performing assets are there, those can be liquidated and a fresh liquidity will be available with the originating bank here, right? So that's the case. Okay, so let's learn about it. So this is what is said over here, but let's learn about it. So securitization refers to transaction where the financial securities are issued, which we say to be security receipts. We also say to be pass-through certificate, PTC, pass-through certificates, or security receipts, we say simply. Okay, and the cash flow arising out of the payment of the interest and principal, let's say if there is any recovery, that will be transferred to the investors. Okay, and SPV is created for the same purpose. I already told you. Now there are two type of the things. One, it is related to the traditional securitization, and the other one, it's related to the synthetic securitization. So when I'm telling you about the traditional securitization, it means a very normal thing. Like I told you clearly that structure where the cash flow from the underlying pool of the exposure is there, and that's going to service the different degree of the credit risk. Now the different degree of the credit risk can be there, like the risk could be of the different types, right? And credit risk could be of different types from the different types of the loans over there, because it's a pool of the loans now. So different degree of the risk is there, but there is not going to be any differentiation between them. So let's say there is a higher risk in one loan, but there is low risk in other loan, but those will not be accountable as a different one. That will be accountable as a single one only, right? So when we're talking about the traditional securitization, cash flow from the underlying pool of the exposures that is used to service the investors. So the investors who have invested the money into like QIBs have invested the money into it. So whatsoever the recovery which will be made from the loan pool account, that will be transferred to these QIBs, right? And credit risk is redistributed. Credit risk is redistributed into the tranches. It is redistributed into the tranches, and there could be different tranches for it. It could be the senior tranche, mezzanine tranche, right? Different tranches can be there. And what about the synthetic securitization? In case of the synthetic securitization, the underlying asset is going to remain on the balance sheet of the originator only. Here is the originator. We say the bank who has given the loan originally, that is said to be the originator. In case of the synthetic securitization, the underlying asset is to be on the balance sheet of the originator only. Credit risk is transferred fully or partially using the credit derivatives, right? Like we learned about the CLN, that was a funded point over there, right? Only the credit risk was transferred. Only the credit risk was transferred using the same. So that technique is used. That is a synthetic securitization. Is that clear? Further after that, it's related to the securitization exposures. It's related to the securitization exposure. Now, what is securitization exposure? So we are going to learn about 3 points over here. One, it is related to the securitization exposure, right? Other one, it's related to the cleanup call, and the third one, it's related to the credit enhancement, right? The first one, it is securitization exposure. Now, securitization exposures are what? These are the on balance sheet and off balance sheet position. These may be on or off balance sheet exposure, right? That the bank is going to assume in relation to the securitization transaction. So when a bank comes in under a securitization transaction, what is going to be the on balance sheet exposure or off balance sheet exposure on that particular bank? That is a securitization exposure. So it could be the credit risk, market risk, liquidity risk, operational risk that the bank is exposed to when the bank is entering a securitization exposure, right? And the different type of securitization exposures are there. It could be the ABS, that is the asset backed securities, like securities which are backed by the pool of loans or receivables. It could be MBS, like definitely it can be ABS. It can be MBS, that is mortgage backed securities, that the securities are backed by the residential or commercial mortgage loans. It could be the credit enhancement, like so as to improve the support that is provided so as to improve the credit quality of the securitization tranches. Like if let's say if the one bank is providing the one bank is protection buyer, the other bank is protection seller. Now we are talking about the securitization exposures. Now it could be there in the books of the protection buyers, and also it can be there in the books of the protection seller. All are to be covered, right? That's the point. And what do you mean by the cleanup call? What is a cleanup call? So cleanup call is an option. It's an option which is going to allow the originator that he or that the bank can be or the originator can be repurchasing the remaining securitization exposure before the full payment of the underlying pool. That's a cleanup call. So it's going to be a option that basically is going to allow the securitization exposures to be called up before the underlying exposure or securitization exposure have been repaid. Let's say the bank gave it for the securitization purposes, but cleanup call can be arranged. Cleanup call can be arranged where the bank is going to recall the unpaid amounts which has not been recovered so far. That's a cleanup call. Okay, now the purpose is what? Sometimes the bank wants to reduce the administrative cost or servicing cost. Let's say the servicing cost is more in case of the securitization. Bank want to reduce that particular scenario, right? That can be done. And also sometimes the bank want to simplify the balance sheet management, definitely, so that it can be done. So it's an option which is available to the originating bank. Okay, and what do you mean by the credit enhancement? So credit enhancement is going to be a contractual agreement where the bank retains the securitization exposure and it's going to provide the additional protection to the investors against the losses. So in that scenario, bank is going to give additional protection to these investors that do invest into these securities or security receipts. I'm going to give you additional protection. The main motive is what? The motive is that the bank wants to increase the credit rating of these security receipts of the senior tranches so that more investors can be investing into these security receipts and so as to absorb initial losses from the asset pool. So that's the purpose related to the credit enhancement. Clear with it? Clear with it so far? So that's about it. And the further point, it's related to the collateralized loan obligation. It's about the CLO, that is a collateralized loan obligation. Now CLO is going to be a securitized pool of the commercial loans. Now it's basically securitization of the commercial loans. And in case of CLO, whensoever the security receipts are issued, those are issued in different tranches, like for senior class, mezzanine class, substandard or equity class, right? In that way the security receipts are going to be issued. So CLO, that is a collateralized loan obligation, is a structured securitization that is going to be backed primarily by a pool of the corporate loans. We can say the senior secured loans or leveraged loans, right? And there will be multiple tranches, there are multiple tranches which will be available to the investors, Now let's have a look at the CLO. So the collateral for the CLO usually reside in SPV. Like just look at this particular picture. So there is a high risk loan portfolio and there is a true sale of the asset. And for the, as I told you, the ARC is going to purchase these assets and it's going to create a SPV, that is a special purpose vehicle. And then it's going to issue the notes. We say to be the credit linked notes or security notes, whatsoever you name it. And further, the investors are going to invest into it, right? But the investors which are going to invest into it, those are actually divided into the different tranches. The cash flows generated from the loans, let's say whatsoever the recovery is being made into these particular loans, that is being going to be like in bucket system. First of all, this bucket will be filled in, after that the second bucket will be filled in, and after that the third bucket will be filled in. So that's basically like trenches. So let's say rupees 100 came, out of rupees 100, 60 will be will be going toward the senior class, that's the most safer one, let's say. And then it will be going to the mezzanine class, will be funded with rupees 20, and the other one will be funded with rupees 10, and the last one will be funded with rupees 5. So the cash flows will be moving in such scenario, right? So whatsoever the cash flows are generated from these loans, that is going to be dedicated so as to pay the debt tranche in order of the seniority. So most senior is going to be paid at the first, right? So the most senior CLO tranche basically can withstand the higher level of the defaults because the cash flow is prioritized in that particular trench, right? So let's say person A has invested into senior trench, person B has invested into mezzanine trench, person C has invested into sub trench, and person D has invested into equity trench that is not rated, right? Now in that scenario, whensoever the recovery will be there, the person A is to get the amount at the earliest. Now we can say lower risk is associated with the senior class and highest risk is associated with the not rated class, right? Definitely that can be the case. Now when the highest risk is available, more return will be there to the D, so that's the case related to it. And how the CLO is going to be different from the credit linked note, how it is different from the credit linked note. Now credit linked whatever the CLO is, right? CLO is going to provide a credit exposure to a diverse pool of credits. In case of the CLO, multiple loans are pooled together, right? Those are pooled together. Whereas in the case of the credit linked note, there was a single credit which was available against which the security receipts were issued, right? And CLO is going to provide a true transfer of ownership of the underlying assets. Those are truly transferred from the originator to the seller, to the buyer, that is the ARC. But that was not the case in case of the CLN. That was not in case of the credit linked note. So that's the major difference between it, right? I hope that you must have understood the concepts related to it. If clear, so do like the video and further share the video at the earliest, and simply just do write CAIIB. If you want to get the complete pack, complete course related to all the 5 papers of the CAIIB, just simply do WhatsApp CAIIB and WhatsApp it to the number 83609 I'll be sharing the complete details to you, like, and you'll be getting the full course videos, chapter wise previous year questions, mock test, mega test, PDF notes, each and everything. The case study videos will also be covered, right? So that will be all. Thank you so much and see you again in the next video.